Yes, my subscribers, my followers, we're going to look at something different this time. And all of us want to make money, okay? And then one term or one category that enhances our money making conditions is what we call investment. And then there are many conditions that makes investment the best way to make money, okay? And so we are going to look at how best we can increase investment returns. I mean the profit that we get on or from our investment, how best we can get it in a bigger condition, in a bigger size. And so this is what we are going to look at. Practically, we are going to look at 8 ways we can enlarge or expand investment returns. I mean the profit that we get on or from our investment, how best we can get it in a bigger condition, in a bigger size. And so this is what we are going to look at. Practically, we are going to look at 8 ways we can enlarge or expand investment returns. And so, strategically, the first point that I would like to talk about is what I call the amount or principal involved. Okay? If you want to make bigger returns on your investment, one thing that you have to look at, one thing that you have to consider is the principal or the seed money, the money that you are going to invest. Okay, it should be in this condition. Look at this one. Let's say you have 2 people. Okay, person A, let me just use the A, investing 450 USD at 9% interest rate, and then B, person B also investing 670 USD at 9% interest rate. Okay, this is the rate of interest. Your dividend is going to be paid based on this rate. You can see that person A has the principal being 450 USD. Person B also is having or investing 670 USD. They are all having the same interest rate. Let's assume that all other conditions with respect to the investment are the same. The only difference is that one is having a seed of principal of 450, the other two is having 670 United States dollars. Okay, by the close of the year or by the close of the maturity period, the interest rate from 450 is going to give us 40.5, as this one is also going to give us 60.3. So the first strategy I want you to understand is this. If you're investing and you want to get bigger returns or a larger interest rate or interest, then you have to look at your principal. The bigger the principal, the bigger your interest. The bigger the starting amount, the bigger your returns on the investment. So this is the first point. Let's look at the second point. The second point also goes with this, the interest rate involved. The interest rate. Okay. Now let's look at this. Say Maria investing 990 at 8%. Okay, and then Jeremy also investing 990 at 13% interest rate. Let's also assume that all conditions are the same. Their maturity period and their compound and whatever, everything is the same. The only difference here is that one is having interest rate of 8% and then the other is having interest rate of 13%. When you do your calculation, say by the course of per annum 1 year, this will give us 79.2, and then this one also gives us 128.7. Okay, so again, if you want a bigger interest or a bigger dividend on your investment, the second point is that you have to search and research and find out where you will get the best interest rate. Again, the bigger your interest rate, the bigger your dividends. The bigger the interest rate, the bigger the amount of profit that you are going to get on your investment. So this is the second point. And then let's look at the third point. It also says the type of interest. I hope you are following whatever you are doing here. Yes. Type of interest. Okay. If you look at this, the third one. In the element of mathematics or investment or whatever, we have two basic types of investment or investment types. The simple interest and then the compound interest. Okay. Now, let's assume I have some calculation, but you won't be able to do all the calculations on the board. So I'm going to do the summary of whatever will make you understand the point that I'm trying to illustrate here. Say Jane, okay, and then Mike. Then let's assume, okay, they are investing. The capital here is 4580. Then 4580. Okay, we have the same principal. The type of interest here is this simple interest, this compound interest. Okay. Now, within the first year, okay, let me do the third year. They are all investing this amount of money, whatever, for 3 years. Okay, but in the course of the 3 years, we are going to have 5541.8 and then 65610.697. Yes. When you do your calculations based on the first year, second year, and the third year, by the end of the third year, this is what Jane and Mike are going to get. You can see that they have the same starting amount, in other words, their principal. But then Jane is having or investing based on simple interest, as Mike is also investing based on compound interest. At the end of the day, they have the same maturity period, okay, and then if they are investing in the same financial market or financial product, because Mike is investing with respect to compound interest, you can see that he's going to have 5,610.697 USD, and then so the difference is clear for you to see. Again, the third point that I want to understand and appreciate that whenever you are going into investment, make sure you search and research and look out for an investment that will give you compound interest. In the field of investment, always compound interest is the best. Compound interest always gives you better returns as compared to simple interest if all conditions are the same. And so these are the 3 points that we look at right now. Let's look at the other points involved. Let's look at the other points involved and see the way forward. Good. Now, the fourth point will be okay, investment maturity period. Maturity period, okay? Yes. Maturity period is the time frame that an investment will take to mature. That is from the starting point to the ending point, or from the starting date. Say 1st of January 2022 to say 1st of December 2022. So we are having 1 year. Okay, this is the maturity period if you do your investment with this 1 year time frame. So the maturity period is how long your principal is going to be with the financial or the investment company before you can withdraw or whatever, you can terminate it if all conditions are to be same. So another practical instance in a simplified manner. Simple interest for, say, Johnny investing 6,500 USD, and then Kelly is also investing 6,500 USD. Okay, all at an interest rate of 9%. 9%. Now, the maturity period. Johnny is investing for 1 year, and then Kelly is investing for 2 years. Okay, by the close of the maturity period, Kelly will get 7085 USD, and then Kelly will also get 7670 USD. Now, I'm not asking you to focus on the calculations. I'm trying to let you understand the concept here. If you are investing and you are looking for a bigger returns, a bigger profit on your investment, you have to look at the maturity period. The longer your maturity period, the bigger your interest earnings on your investment. That's what I'm trying to let you understand. So you can see that Johnny is investing for 1 year, Kelly is investing for 2 years. Now they all starting with the same principal, with the same interest rate. The only difference is that one is for 1 year, one is for 2 years. So the longer your investment period or your maturity period, the bigger your earnings on the investment. Okay, so let's move on to the fifth point, number 5. I said we're going to look at 8 ways. Okay, so the number of compounding periods. Remember I've said that between simple interest and compound interest, the best form of interest that will give you a bigger returns is the compound interest. Now you are looking at compounding interest. Compounding interest is simply the number of times your investment is going to be turned around, okay, within a particular maturity period. Okay, so let's do this. In investment, you can get 1 week, or let's say weekly, monthly, and then quarterly, and then semi-annual, and then annual or year. Okay, these are the compounded conditions or periods in investment. Okay, so let's say one is investing with respect to, we are going to look at 3 individuals here, but then I want us to summarize everything in a simple table so that, see, Martin and then Bobby, and then you also have see Oscar. Okay, and then let's do this. 5,000, 5,000, 5,000. Okay, and then we are having the interest rate is 8, 8, 8, all in percentage. And then we are having annual, let's say 8 annual, and then semi-annual, and then monthly. This is the compounding period. Annual. So every year, they are all investing for 3 years. Every year means that it's going to be compounded 3 times within the 3 years. Semi means half a year, which means that every 6 months. So it means that 2 in a year by 3, you're going to get 6 periods. And then monthly means that every month is going to be compounded, which means that 12 in a year times 3 will give us 36 compounding periods. Okay. Now, by the course of the year, the first one, which is Martin, will get 6298.56, and then 6326.60, and then there will be 6427.34. This is a simplified calculation. I've eliminated all the calculations that involves. Okay. Now, Martin, they are investing with a starting capital of 5,000 USD. They all have the same interest rate. Okay. They are all investing with the maturity period of 3 years. Okay. Then the difference here is that one is going to have a compounding period of annually every year, so 3 times in a year. Semi-annually, it means that 2 times in a year, multiplied by 3, giving us 3 compounding periods. And then monthly means that every month, which means that 12 in a year, multiplied by 3, we're going to get 36 periods, compounding periods in a year. If you look at the end results, it means that you have 6 years, 6 years, 6 years, so the 6 can cancel out. Then you can say that 4, 3, and 2, or 2, 3, and 4, which means that with the same amount or with the same conditions of investment, the more you compound your investment, the bigger your interest, or the bigger your end, or the money you're going to get at the end of the period. So once again, if you're investing, it's good to research and search. You can go to 3 or 4 financial institutions or investment companies. Try to look at their conditions as we explained, then you can make your selection. If you just go and invest for investing sake, you may not get the best returns or the best conditions of favoritism in your side. The 6th point with respect to how best we can expand or get a bigger interest on our investment is to consider the degree of risk with respect to the investment. Now, investment is such that the risk is always equal to our returns. Okay? Yes. That is why the higher your risk, the higher or the bigger your investment, bigger your returns. Okay? And so, if you are looking for, say, 50% interest rate, then you have to also consider that you can lose all your investment. That's what it means. And so, the smaller the interest rate, the smaller the risk. Okay. So if you are looking for a way to get a bigger interest on your investment, you have to keep this in mind. Okay, you have to keep this in mind because risk is always equal to returns. The higher your risk, the bigger your return. The lower your risk, the lower your returns. So this is what I want you to understand with respect to whatever you are discussing right now. Now, the 7th point is this one. Let's see. Type of investment. Type of investment. Yes. When you talk of investment, we have so many products of investment. Okay. We have so many products of investment. Now, I've said it and I want to repeat it here. If you want to go into investment, do search and research. Okay. Understand whatever you are going to invest in before you do that. Now, you can get investment like in financial investment product like stocks, giving you say 8%, and then bonds will give you around say 9%, and then say CDs, certificates of deposit, giving you say 7%, with the same say 5,000 USD being the principal. What it means is that if you want to go into investment, it's good for you to search and research to know where you can get the best interest rate or the product that will give you the best interest rate. Okay, because every investment has its own interest rate, so you have to do your research, know where you get a better returns investment. Then the last one, let me do it slightly. The last one, which is the endpoint, to consider if you want a bigger interest or bigger returns on your investment is number 8. I call it the area or location of investment. Yes, the area or location of investment. Let's assume I'm investing in stocks, okay, in the US of A, say California, okay, and then I'm also investing in stocks. Another person also investing in stocks in GA, say Princess Town, okay. Yes, investing in stocks in the USA, California, may give you bigger returns than investing in stocks in GA, Ghana, in Princess Town. So whenever you are going into investments, it's about you to do what I call search and research, to know the area or the location that will give the best safety and bigger returns on your investment. If you just stand up and say that you have this money, so I'm going into investment, you may not get anything on your investment, or you may even lose your investment. So it's good for you to do your research well and then follow these 8 points that I've discussed with you today in this video, which will help you to get a better returns. Okay. The principal, the interest rate, the maturity period, the type of investment, the compounding periods, even the risk, the location, and everything needs to be understood and understood well before you finally go into investment. Investment is something that is very good, but then putting your hard-earned money into investment without doing the due diligence of research means that you can lose your money. And so thank you for watching my videos. As usual, be sure to subscribe to my videos and then share my videos. Thank you.